Hi everyone, this is lecture 10 of the 2026 mentorship program. In this lecture, I will be doing a top-down analysis market review on this week live top-down analysis. On the daily time frame of the dollar index, last week I talked about the weekly order block. I told you guys that as long as price is below the zero point 0.5 level of the mid-range of the order block, I will be anticipating lower prices for price to run out previous week low, and if I were to trade lower, price to trade lower. Overall, bias was that I'm anticipating lower prices. Now, based on the price action, you can see that this is a one candle trend trading lower, closing below the overall bias, which is the sell side liquidity. In most example, this is one of the I can say one of the rarest time where you see an impulsive price action on a currency like a forex pair, mostly dollar or euro USD. Seeing this impulsive price trading lower, running out the sell side liquidity is not a common thing in price. If I were to say it's not a common thing in price, but it's very possible to happen if there is a lot of fundamental around it. There's a chances of price declining like this. But I would have liked price to take its time week after week, at least a 3 week time period to trade lower to run to my overall bias. Because most times like this, because you want to expecting price to trade lower completely like this with this kind of volatility, so trade lower, you will be taking profit from a low hanging fruit target, hoping that if price were to retrace back to the weekly range, you wouldn't be involving that trend. So don't expect price to respect the points of interest and use 1 week to play out completely to the overall idea of the sell side liquidity, just like this, because this is a high, like I said, this is one of the rarest time to see a price action where Euro USD is moving below 250 pips in a week. So I'm just putting it out there so that you guys will understand that we're trying to look at price from an average perspective. What is the most average thing price would do based on a certain condition? In the conditions like this, most times you will see price retrace and you will see a steady downtrend from the daily time frame going for the sell side liquidity. But all in all, we're anticipating lower prices and price delivered to our target. Now, I've been calling out price on the YouTube channel, and if you were to go through to look at the accuracy, you can see when it comes to overall bias on a weekly perspective, I've been right most of the times, calling price from the tick on where price is actually trading to, telling you guys on where I'm looking at price to trade to and how to anticipate price. One of my key purpose of having this 2026 mentorship program is to teach you guys how to replicate the idea of anticipating your bias personally, having that personal opinion on where you want price to trade to, and having a strong probability of getting it right on where price is trading to, using the technicals and applying a few fundamentals when there's a fundamental when there is a strong fundamental to price action. So make sure you go through the previous lectures, understand how I derive my bias, how I point out the points of interest I'm intended in trading by, looking for price to respect or looking for price to trade to. What are the draws on liquidity? How I identify them? And now, the 2026 lecture is to show you guys how to use the 2025 lecture. So I can tell the beginner trader, if this is your first time going through the lectures, that you should go through the 2025 mentorship program before actually going through the 2026, because there are some questions that traders are asking that I'm answering the questions on my Telegram, which you can find the link in the description if you have any question to ask. But most of those questions have already been answered in the 2025 mentorship program, and with an example, some with a live example, while some with a pre-recorded example. It's depending on the question you're asking. Now, most of the questions already been answered on the 2025. What I normally do, I answer the question and reference you to a lecture on the 2025 lecture. Try to show you guys that what is being used already been taught in the 2025. I'm just showing you guys how to apply it on a daily basis, how to use it as a swing trader, an interweek trader, a day trader, and an intraday trader. Just showing you guys how to apply it correctly. On the daily time frame, on the dollar index, on the daily time frame, I talked about price trading below the zero point 0.5 level. I told you guys that looking at this order block, price might expect the order block to trade higher and trade above the zero point 0.5 level. That before taking any setup, before regarding any trend in price trading lower, I need to see price go below the zero point 0.5 level. And if price were to trade below the zero point 0.5 level, then I will be anticipating lower prices. On Monday, price traded below the zero point 0.5 level, which I was anticipating lower prices to run the sell side liquidity. And for those in the Telegram channel that I do drop commentary, I posted a screenshot after price traded below the zero point 0.5 level to you guys that I'm anticipating lower prices to the sell side liquidity. That was actually a screenshot I posted before actually taking advantage of the trade on GBP USD. So price retraced to a daily on Monday point of interest, respected it, traded lower, took out the sell side liquidity on Tuesday. Wednesday retracement, forming a daily fair value gap. Thursday traded lower, forming an order block, and the order block was aligned with the new week opening gap. And you can see how Friday retraced to the new week opening gap, the same level with the other block, which was on Wednesday. Respected it, traded lower, took out the sell side liquidity, and overall run on the overall buyers. Looking at this price action for day traders, if you want to take advantage of this, after I posted the screenshot on the Telegram talking about how price have traded below the zero point 0.5 level, if you're a day trader, you know that the next day you will be anticipating lower prices for day traders that will take advantage of the London section and the New York section. That you're anticipating lower prices and you want to see a classic power of three trading lower to run the sell side liquidity. Same thing goes to on Wednesday for price to run the previous week low. Now, on Wednesday, price did not actually run the previous week low. We did a retracement back to the range. Now, it's not about the buyers being right all the time. It's all about when price is fully aligned with the buyers, you're taking advantage of it, accumulating your accounts, compounding those profits that it will override the losses that you're going through. As long as you know how to stick to the slower time frame trend, it will save you from days like on Wednesday where price actually retracing to a higher time frame point of interest before actually trading lower. Now on Thursday, I was actually looking for a retracement to the daily fair value gap. But on Hero USD, price retraced to the daily fair value gap. So there was an SMT from Wednesday's high to Thursday's high. There was an SMT before actually trading lower. Friday retracement using Wednesday as an order block. At the same time, we're expecting a new week opening gap, trading lower to run the sell side liquidity before the overall buys. On the 1 hour time frame on the dollar index, after Monday traded below the zero point 0.5, you can see how Tuesday retraced, new week opening gap, At the same time, it was aligned with the 1 hour order block, respected it, traded lower, retracement, 1 hour fair value gap to trade lower. After the run on the sell side liquidity, trading below a daily fair value gap, trading below the new week opening gap, price did a retracement on Wednesday, Thursday, SMT with Euro USD, traded lower Friday, retracement using the new week opening gap as a resistance level to trade lower. At the same time, we're expecting the other block, which is the Wednesday candle. We expected it to the tick before actually trading lower, running out the sell side liquidity. Taking out the sell side liquidity led to the continuation to the overall bias. Now, the major point of interest price were expected on the 1 hour time frame is the new week opening gap with the daily inversion fair value gap. At the same time, looking at this new week opening gap on Tuesday, looking at this new week opening gap on Friday, those are the points of interest price were expected. I talked about the continuation, the 1 hour continuation trend on Wednesday. There was a lecture I posted on Wednesday, so make sure you go through the lecture. I talked about how to trade the London section. That was when price retraced to the 1 hour fair value gap. The drawn liquidity was the sell side liquidity. Now, I used Hero USD for the example. The point was that not every broker offer liquidity to trade the dollar index. In some brokerage accounts, you can find DXY to trade. So you turn to Hero USD because they're inverse correlated. I think they're around 90% correlated when it comes to trend. So on Hero USD, I use it as an example to show you guys how to take advantage of the setup when price is fully aligned with your bias to trade lower. Price took out the sell side liquidity on Tuesday, Wednesday retracement, and on Thursday, still aligned after the SMT, anticipating lower prices. Look at those key sections. Those key sections like the London section and the New York section. Those are the key sections for you to pay attention to. Look at the point of interest the 1 hour is respecting during those times, and look how price is trading lower. Mostly when the 1 hour is aligned with the idea. If the 1 hour trend is aligned with the idea, like a run on liquidity to a daily point of interest, those are the times for you to anticipate a reversal before the initial trend. Now, I wouldn't be going to the lower time frame in this lecture because I'm trying to keep the lecture short a little bit so that you guys can easily go through the lecture and derive what I'm trying to explain in every individual lecture. On the weekly time frame on Hero USD, I talked about the weekly order block. Showed you guys that price is still above 0.5 level that I'm anticipating higher prices to run the buy side liquidity. And you can see how price traded higher, running out previous week highs before running to the overall target, which I talked about on the dollar index that there's a rare time in price that the fundamental was high, the technicals was high, leading to these higher prices for price to trade higher to run the buy side liquidity. On the daily time frame on Hero USD, I talked about price trading above the daily fair value gap, using it as an inversion fair value gap to trade higher. And my drawn liquidity is the buy side liquidity, which is the swing high. And you can see how price traded higher to run the overall target. On the daily time frame, after The first run on the buy side liquidity, where Monday trade above the daily fair value gap. Tuesday used the daily fair value gap as an inversion fair value gap. I talked about it. Traded higher, took out the buy side liquidity. Wednesday retracement. Thursday used the daily fair value gap as a support, which I talked about the XMT from the dollar index. Trading higher. Friday used Wednesday as another block, respected it, trading higher to run the buy side liquidity. On the 1 hour time frame on Hero USD, after price trade above the daily fair value gap on Monday, you can see the retracement to daily fair value gap where price used it as an inversion fair value gap on Tuesday, respected it, traded higher, retracement to a 1 hour fair value gap for continuation, traded higher, trade above a new week opening gap, running out the buy side liquidity. Retracement on Wednesday, Thursday, traded lower, took out Wednesday's low into the daily fair value gap, respected the daily fair value gap, anticipating higher prices to run the swing high. Shift in structure, retracement, 1 hour point of interest, which was aligned with Wednesday order block. Here's it, a breakers block on Wednesday. Look at this swing high to the swing low. Not much of a trend to say that the breakers block is here. You can see this is a direct trend to the daily fair value gap, and you can see the same trade through the swing high, making it a breakers block. Retracement to the breakers block, supported from the breakers block to trade higher to run the buy side liquidity. Now, the reason I'm talking about those 1 hour point of view trades where there was an expansion and areas for you to look at on the 1 hour time frame is for those that are intraday traders and day traders. Those are the times you look for your buys when you have a clean bias. First was the retracement to the daily fair value gap. Second was the 1 hour fair value gap before the run on a daily point of interest. You look for that retracement, daily fair value gap. Those are times for you to look for your entry. Trading higher to run the swing high. After the run on the swing high, retracement, breakers block. It should be the support for you to buy to anticipate higher prices to trade higher to the overall target. These are the points of interest. Those are the times for you to study on. Look at how price reacted on those times where price is using those points of interest as a support trade higher. On the weekly time frame on GBP USD, on this week live top-down analysis, I talked about price that currently on the weekly time frame on GBP USD, looking at how the weekly time frame is structured, is looking at like price retracing to the weekly fair value gap that is not aligned with the dollar index. But if the daily time frame were to align with the dollar index, then I will be anticipating higher prices to run the weekly high, which means I need to see a daily shift in structure for me to anticipate higher prices to run the weekly high. And if it's aligned with the dollar index, then I will be taking advantage of the trade. On the daily time frame on GBP USD, last week I talked about the daily fair value gap. For the trade above the daily fair value gap, I will be anticipating higher prices to trade to the weekly high, which I will consider as an internal shift before the initial shift of running out the buy side liquidity. sticking with the idea for price to trade higher to the weekly high. On Monday, trade above the weekly fair value gap. Tuesday, use the weekly fair value gap as an inversion fair value gap to trade higher. Came close in running out the buy side liquidity, but on the dollar index, price took out the buy side liquidity. So after price took out the buy side liquidity, I closed the position I was holding from the daily inversion fair value gap. So I closed the position knowing that there might be a retracement to a daily point of interest, which on Wednesday price retraced back to the other block, which is this candle, before the gap in price, back to the other block. We expected it. Thursday traded higher, took out the buy side liquidity. Friday continuation, running the overall target. On the 1 hour time frame on GBP USD, on Monday, after price traded above the daily inversion fair value gap, Tuesday price retraced to the other block, which was my entry, and it was aligned with the daily inversion fair value gap to use as a support to trade higher to run the buy side liquidity. And you can see how price supported at the same time aligning with a 1 hour order block. Took a buy, stop was at the swing low, price respected it, retracement, 1 hour fair value gap, traded higher, came close to the buy side liquidity before on Wednesday retracement. After price retrace, back to the daily inverted fair value gap, aligning with Friday's candle, which is now another block. We expected it Tuesday, took out sell side liquidity, shift in structure, retracement, and on Friday, price traded higher, continuation. For those that were anticipating higher prices, if you know how to trade the day trading idea, understanding power of three, here's the classic power of three. Friday continuation, trading higher, running at the weekly high. So the trade I took advantage of on the 1 hour time frame was this trade. Stop was at the swing low, target was at this high. Now it was a 5.7 hour trade, 5.7 hour trade before the retracement because price took out the buy side liquidity, which is the low hanging fruit on the dollar index, and there might be a retracement. So I closed it after the run on the sell side liquidity on the dollar index. After that, I didn't actually take any trade because looking at this price action, it still wasn't aligned with what I was looking for because I want to see a run on this high before actually waiting for a retracement to buy from, which happened on Thursday, leading to this run on the buy side liquidity. Now a retracement to which is this candle, the other block, or even the fair value gap would have been a good area for me to take a 1 hour setup. But clearly you can see the price did not actually retraced. Did a little bit of a retracement before actually trading higher to run the overall target. So this was the trade I took advantage of on GBP USD. On the weekly time frame on USD GPY, on this week live top-down analysis, I talked about price using the daily fair value gap as a support to trade higher. And I told you guys that it wasn't aligned with the idea on the dollar index. I'm not going to be taking advantage of any setup trading higher to run the buy side liquidity. Now, I told you guys that if you are to trade the currency pair, you need to take account of correlation. You need to understand what the dollar is actually doing because most pair trade like the dollar index. It doesn't matter the actual past trend. It's just that whenever there's a strong bias on the dollar index, other currency pair that is correlated with the dollar tend to trade to that bias. They tend to trade with the bias. So if I have a bias on the dollar index, I want to see USD JPY aligning with the idea, which I was anticipating lower prices, which from a weekly perspective wasn't aligned with the idea. On the daily time frame on USD JPY, and this week's top analysis, I talked about the daily fair value gap that price might expect it to trade higher to run the buy side liquidity. That I'm not going to be taking advantage of the setup because it wasn't aligned with the dollar index. But if the daily were to align with the dollar index, then I will be taking advantage of the sell trading lower. Which you can see that on Monday, the price traded higher. Tuesday, not much of a trend. I can see a few consolidation, trade higher in the morning, but later retraced back, stopping out traders. Wednesday, ranging day. Thursday, took out Tuesday's high before your deep retracement. And on Friday, took out Thursday's high before the trend trading lower. Now, did I take advantage of the setup? No, because I told you guys that I need to see a daily trend aligning with the idea. Looking at this price action, this is not a daily trend aligned with the idea. Because on Friday, Euro USD traded lower impulsively, leading to this price action, which I've told you guys that it doesn't matter what currency pair you're trading as long as it's correlated with the dollar. When the dollar has a strong bias to a specific direction, other currency that is correlated with the dollar index tend to trade to that direction. That was the reason I didn't take advantage of any setup because if the dollar were to trade lower impulsively with a high liquidity, that will lead to lower prices on USD JPY, which if you have to take a buy, it will derail you out of the road to trade lower. So that was the reason I didn't take advantage of this setup. Now you can understand correlation. You can see why I take account of correlation. Here's a good example on why I take account of correlation. On the 1 hour time frame on USD JPY, looking at this price action, anytime you see an impulsive move trading lower, going against the buyers, taking out stops, those were the times where the dollar index was trading lower impulsively. If you were to look back at what price did on Tuesday on the dollar index, price traded lower. So if you were taking a buy, correlation correlating with the dollar led to this lower prices running out your stop. Those are for those that did take advantage of the buy from the dollar from USD JPY daily fair value gap. You can see how price stopped you out. That was the reason I like to see the correlation in price before actually taking a setup. After that, came back to the daily fair value gap, respected it, internal shift, went above the new week opening gap, used it as a support to trade higher, with most traders were looking for a complete run on the buy side liquidity. On Friday, when price was trading lower, because there was a retracement on the dollar index on Wednesday, that led to these higher prices. But on Thursday, lower prices, retracing back to the 1 hour order block. Friday, complete run on the stop. So for those that were holding the buy, trading higher, I told you guys that understand correlation, know how the dollar is correlated to your currency that you're trading, and pay attention on how the dollar is trading. If the dollar has a strong bias to where it's trading to, it will correlate with pairs that are correlated with the same bias and it will trade against the initial trend on those currency, leading to the lower prices. And you can see how impulsive those this price action were, mostly because there were liquidity below the swing lows for traders that were looking for higher prices to trade higher to run the buy side liquidity. So there was a lot of stops below the swing lows leading to this price. Trading lower leading to lower prices, trading below the daily fair value gap. So, in this lecture, make sure you learn how to take account of correlation. I told you guys the benefit of taking account of correlation, understand when to actually look for those setups, when to trade, and when to let the market do its thing. It's very important to understand how your currency reacts to the dollar, understand those correlation before actually taking any trade. So far, I only took advantage of one trade, even even if price did traded impulsively throughout the week. I don't like to see price trade impulsively like this because there's a whole lot of time if price were to trade gradually, trading lower. A lot of time for you to take advantage of good setups. But an impulsive move like this still doesn't favor lots of trader unless you might be lucky in taking a sell before the initial move, then holding up the trade, taking partials as it trades higher. Because seeing those impulsive price action sometimes I take off my take profits. I only take partials because looking at the price action is more likely for price to expand. But it's very rarely I do that. But this would have been an example for me to do those type of trading, taking partials, multiple partials. Sometimes I like to leave the quarter of a percent to run to the full target. Mostly when price already traded to my low hanging fruit, I like to close half of the position. Sometimes I close 75% of the position and let the other 25 run to the full target. The reason I'm talking about trade management because if you were to do this for a long time, there will be a time where price will trade higher than your initial target, trade more and more to the direction you were anticipating price to trade to, and how to take advantage of it. Once you notice it from the daily time frame that there is a more likelihood of price trading higher and you are already in a good position, you just take most of the position out and let the rest run. Now, do not do this on the beginner stage. I've talked about it. That if you're a beginner, learn how to take profits. Learn how to take profit at the low hanging fruit so you can record as that trade as a win to give you more confidence to take losses and to give you more confidence to learn this more. So, not giving back the profits you already made back to the market, holding up to your profit, learn how to minimize your losses, learn how to follow your plan. It's very, very important going in this lecture. So as a beginner trader, I wouldn't advise, but put that in mind that once you get to that stage, now when will you get to that stage? I don't know. It's mostly about your experience. When you can look at price and still anticipate price to trade further to a bias, that your first take profit was still aligned with the bias, but you looked at it that you were only taking a small partial of the trade. That if you were to expand your take profit, it is still fully aligned with the trade bias, but for a safety net, you take partials once it gets to the first profit and let the rest rise to your overall targets. So that's it for this lecture. See you guys in the next lecture.